All right, let's get right into it. Today, we're going to break down one of the biggest distinctions in finance, and we're going to do it by telling a story about a very, very expensive lesson. Seriously, this thing cost over 100 grand and all started with what looked like the deal of a lifetime. So I want you to picture this for a second. There's this massive, gorgeous, five-bedroom Victorian house, the kind with real character, real history, and it pops up for sale at a price that, well, it just seems way too good to be true. This is where the story of a genius move really kicks off. And that's the feeling, right? When you think you've spotted something nobody else has. You feel like you've totally cracked the code. The excitement was just off the charts. It was this perfect storm of a beautiful property and some really juicy local gossip. $80,000. That was the price tag for a five-bedroom historic home. I mean, that's less than a new luxury car. It felt like an absolute no-brainer steal. Like the game was won before it even started. What could possibly go wrong? Well, here's why it all seems so brilliant. The rumor mill was on fire. Word on the street was that a huge tech giant was about to build a brand new campus right down the road. Everybody was whispering that property values were about to explode. That $80,000 house, people were saying it was going to be worth $300,000, maybe even more, practically overnight. But this is the exact moment where the dream starts to pivot into a pretty harsh reality. Because let me tell you, betting on a rumor isn't an investment plan. It's something else entirely. And knowing that difference, well, it's everything. And you can see the two paths so clearly right here. On one side, you've got speculating, which, let's be honest, is exactly what was happening. It's gambling. It's built on hope, rumors, and a whole lot of optimism. But then, on the other side, you have real investing. That's built on proof. It's about doing your homework, about due diligence, proven demand, and here's the big one, current cash flow. A real investor asks, does this thing make me money today? A speculator is just hoping, praying that someone else will pay more for it tomorrow. Yeah, the whole decision was completely wrapped up in that one story about the tech company. I was so blinded by that potential future that I didn't even bother to look at the present reality. I didn't check if the town's economy had more than one trick up its sleeve, or what the actual demand for rentals was. All the boring, hard data that a true investor would have started with. And here's the thing. When your entire foundation is made of nothing but a rumor, it really doesn't take much for the whole structure to come crashing down. That amazing future that I'd bought into, it was about to completely vanish. And there you have it, the pin that popped the balloon. Just 6 months after closing on the house, the company canceled the whole project. The entire reason for the purchase, the whole basis for that $300,000 valuation, gone. Just like that. And the pain wasn't quick, believe me. It was a slow, agonizing burn. After the news broke, that big, beautiful house just sat there, empty. For an entire year, it was nothing but a money pit. Mortgage, taxes, insurance, all bleeding out with zero income to stop it. The dream had officially become a very real, very expensive nightmare. This quote just hits the nail on the head. Of course I tried to rent it out, but the property was totally out of sync with what was actually happening in that town. You can't rent a high-end palace in a market where nobody can afford it. The asset and the environment were a complete mismatch, a fatal flaw that I was blind to because I was so busy staring at that fantasy future. So, in the end, I had to sell it for $50,000. That's a $30,000 loss just on the price. But then you tack on a year's worth of mortgage payments, taxes, and all the upkeep, the total damage was way, way bigger. A truly painful six-figure mistake. They say failure is the best teacher. And this experience was one heck of an education. It was expensive, for sure, but it led to a simple checklist that could have stopped this whole disaster before it even started. And that's what I call the anti-ghost town checklist. It's a super simple framework. First, cash flow is king. If the deal can't pay for itself based on today's reality, you're not investing, you're speculating. End of story. Second, look at the economic diversity. You never, ever want to bet it all on a one-horse town. And third, and this is absolutely the most important one, you have to define your exit strategy. What is Plan B? So this is what it all comes down to. The single biggest thing that separates a smart investment from a wild gamble is just one simple question. This is the safety net. This is what separates hope from a real strategy. This is it. This is the question I never asked.
If that tech company bails, can I still rent this house out to a local family and make a profit? The honest answer to that question would have been a hard no. And that one little question would have saved me from this entire mess.
See, asking about Plan B forces you to get your head out of the clouds and look at the reality of the deal. It makes you analyze it based on what it actually is right now, not based on some story you heard. It's your ultimate defense against hype. And that really is the bottom line, isn't it? A real investment is a business. It's designed to make money from day one. A speculation? That's just a belief. It's a hope that the future will play out just the way you want it to. So the next time you're looking at a big decision, just ask yourself, which one are you actually buying?